So it finally happened. The Fed has cut rates for the first time since 2020 after this rate hiking cycle. On September 18th, as you can see, we lowered the rates from the previous 5.5% down to 5%. So a total of 50 basis points, which is pretty big historically for a first rate cut. In fact, in both 2000 and 2007, the Fed's initial rate cut was 50 basis points, and in the coming 2 years, we saw a 51% decline and a 57% decline in the S&P 500. Now, I'm not trying to be doom and gloom. Obviously, there are differences between what happened in 2000, 2007, and today's times. But of course, it's important to be aware of previous patterns in the markets and how they correlate to today. And of course, the question you probably all have, what does this mean for the market over the coming months and years? What data are we still waiting on to make decisions as to whether or not we're going to reduce our portfolios or buy more positions? This is going to be the shortest, most concise possible video I can make on this, so let's get started. So the first thing I want to point out here is this dot plot. So yes, it was scary that the Fed cut by 50 basis points, but you have to realize that it's not just about the initial rate cuts, it's about what the expectation is for rate cuts in the future. Most FOMC participants are expecting to see rates around 5% by the end of 2024. The majority think that by the end of 2025, we will have rates around 4.1%. And then the majority by 2026 think that we're going to have rates closer to 3.1%. So the market can see bigger fluctuations based on expectations of where Fed funds rates are going to be, rather than just the initial rate cut itself. And then, of course, another really important data point when we're looking at potential recessions and market pullbacks is unemployment. So data in August came out with the unemployment rate at 4.2%. It's very important to the Fed. Apart from lowering rates, they want to keep the unemployment rate low to try and keep a recession at bay. This article obviously shows that the Fed's latest outlook suggests that we will see rates at 4.4% by the end of the year, and they're trying to keep unemployment steady at 4.4 through 2025. During Powell's meeting, he also said that the unemployment rate is low by historical standards, which is true. And although it is rising, it's not in conjunction with widespread firing. So now that we've had all this data come out, PCE, inflation rates, GDP, this week, there's a few other things that the Fed is going to be looking at to make more determinations as to whether or not they're going to continue cutting. We did have PCE, which showed a decrease in inflation as well, so that's more economic strength. There's more labor data coming out in early October. And then in mid-October, we have the next CPI report, which is obviously going to be super important for what the Fed does at the next FOMC meeting, which is in 39 days. Currently, there is a 46% chance of a 25 basis point cut and a 53.3% chance of a 50 basis point cut. Honestly, that's a little bit surprising to me because we had such a large initial cut. I think it is a lot more likely that the Fed either does nothing at the next meeting or cuts by 25 basis points. Obviously, Powell is being very cautious here. He's not trying to spook the markets. He wants to see how data presents itself and then make decisions as he goes from there. In my opinion, I think it's easier to cut less initially and be able to cut more as you go than cutting too much in the first place and risking seeing some kind of an event in the economy itself. So what I find amazing, this is an interesting data point from this guy Holger, is that the soft landing story is still a dominant narrative in the markets. We have never had a soft landing before, yet the data shows that most investors are expecting a soft landing. It's increased from 76 to 79%, and only 11% of investors currently believe that there's going to be a hard landing. And obviously, when you see media posting about soft landing narratives being true, oftentimes that's probably not going to be the case. Just another thing to note, to be cautious with your portfolios when the majority think that one thing is going to happen and only a minority think there's going to be a hard landing, especially when from a historical standpoint, we've never had a soft landing. So it's amazing that only 11% of people think that there's going to be a hard landing and 79% think there's going to be a soft landing. I also want to go over what I think is going to happen with the markets as a whole. I'm going to take a look at SPY, QQQ, Bitcoin, and a few other names that I've been adding in the community. QQQ is super close to all-time highs. The S&P 500 has already hit all-time highs again. When the Fed cuts rates within 2% of an all-time high, look at the returns that we get over the next 3 months, 6 months, and within the next year. Every time this has happened since 1980, we have seen a green return, an average return of 13.9% within the next year and 9.8% median. So 100% of the time we're higher since 1980 after the Fed cuts rates within 2% of an all-time high like we are at today. So statistically, that makes me believe that in the next 12 months, we will be higher than we are today. Now, I know we're talking about the S&P here, but on QQQ alone, a 14% return would put us at $555 a share. And as you guys know, we do trade futures in the community, but it correlates to QQQ as well. We trade NQ. All throughout this whole dip that we had on NQ and QQQ, as well as this dip, we've been adding to a swing trade that we finally closed on Thursday and Friday of last week for a ridiculous return. The trade idea was a return back into this daily fair value gap on NQ, which correlates to that 490 level on QQQ. So we were adding in the 445 and 450 range, and we just closed for profits in this daily fair value gap. I still think the target is bullish for the coming weeks and months. We haven't reached the 50% level of this daily fair value gap, which I think is the potential ultimate draw. But also looking back at NQU, which was the previous contract for futures, we have tons of equal highs in this area, which correlates to all-time highs on QQQ. So I wouldn't be surprised if we get back to all-time highs relatively soon. But keep in mind, even in 2000 and 2007, when we had the initial rate cuts, there was some bullishness in the markets, and then we saw massive declines afterwards. So you have to be careful. Don't be adding massive positions here to any companies that you don't plan to hold for the long term. We have been adding Tesla over the last few months and selling puts, closing them for between 50 and 80% profits in fractions of the time that it takes for expiration of contracts. So we've been making some really good money on those. Also on September 10th, we added PayPal at $67.30. We just closed out the position for a huge gain at buy side liquidity at $76.54. We saw almost no drawdown on that. And of course, our Alibaba position is up nicely. China has been stimulating the economy by injecting a lot of money into their banks. Beijing is now considering injecting 142 billion of capital into its banks. And of course, the market is looking at this positively. We bought Alibaba between $77 and $80, and we just closed out the position for a full take profit at $105.05. So if you guys want to join a community and you want to take advantage of some of these swing trades, there is currently a free 3-day trial. You can click the link in the description below. Also follow me on X. I post there every single day. Day trade ideas, swing trade ideas, and a lot of other information related to economics and data. That is it for today, guys. There's a ton of data coming out this week. Best of luck with your trades. I will also be live trading on YouTube. If you guys want to come and join, you are welcome to. That will be completely free. Hope you learned a lot. If you have any questions, send me a DM on X or comment down below.